While you are waiting for Jerome Powell to officially wave the white flag, the smart money, the hedge funds, the whales have already left the building. That 5% risk-free return you have been hugging like a teddy bear, it is a dead yield walking. It is about to evaporate. And if you think you can just pivot to Nvidia now, you are hallucinating. You are stuck between a melting ice cube of cash and a tech market priced for absolute perfection. One bad earnings call, one slip up, and we see a rug pull that will make the 2022 bear market look like a Sunday picnic. But here is the truth. The mainstream media is hiding from you. The crash isn't the problem. Their rotation is the opportunity. We are entering the great wealth transfer of 2026. If you are paralyzed by fear, you become the liquidity for the whales. You become the bag holder. But if you are prepared, you build what I call the nuclear bunker portfolio. I'm talking about locking in double-digit yields and buying dollar bills for 70 cents before the window slams shut. We are going to build a dumbbell portfolio. This is the strategy used by the most sophisticated funds on Wall Street. On one side, we need massive fortress-like income to pay your bills. On the other side, we need deep value and structural growth to build your fortune. To survive the coming shift, you need cash flow first. Not paper gains, but cold, hard cash hitting your account. This brings us to a sector that is completely misunderstood by the retail herd. Business development companies. BDCs. But not just any garbage BDC, we are talking about the absolute royalty of the sector. Hercules Capital. HTGC. Hercules is the Goldman Sachs of venture lending. They don't lend to failing brick-and-mortar stores. They lend to the high-growth technology and bioscience companies, the future of the American economy. Here is the secret sauce regarding the rate cuts. When interest rates go down, what happens to startups? They thrive. Their burn rate goes down. They raise more capital. The IPO market reopens. Hercules Capital actually benefits from a Goldilocks scenario where rates are lower, so their borrowers are healthier, credit quality improves, and loan volume explodes. Let's look at the forensic data. Look at their Q3 earnings report. I want you to focus on one number, the dividend coverage ratio. It is sitting at 128%. Do you speak finance? Let me translate. That means for every single dollar they hand you in dividends, they are actually generating $1.28 in net investment income. They are swimming in cash. They have so much undistributed income spilling over their balance sheet that they are legally forced, to pay you special dividends on top of the regular yield. While the rest of the market is panicking about net interest margins compressing, HTGC is sitting on a mountain of spillover income. You are locking in a 10% plus yield on a company that acts like a high-growth tech ETF, but pays you like a distressed junk bond. This is the arbitrage you need to exploit before the market wakes up. Once you have that income shield secured, we need to pivot. We need to look at the assets that have been decimated by the Fed's tightening cycle, creating a generational entry point. I am talking about the sector everyone has hated for 2 years. Real estate investment trusts, REITs. For the last 24 months, REITs have been the ugly duckling of Wall Street. Why? Because when the risk-free rate is 5%, nobody wants to deal with the risk of owning real estate for a 5% yield. High rates crushed their business model. But guess what? The tide has turned. The Fed pivot is the green light. We are seeing a mechanical, mathematical repricing of these assets. You have 2 plays here, and you need to choose your fighter based on your aggression level. If you are conservative, if you want a bond proxy that pays monthly, you buy Realty Income. Ticker, it's boring. It's unsexy. It's a landlord for 7-Eleven, Walgreens, and Dollar General. But that is the point. It is the definition of defense. As cash yields in money market funds crash from 5% down to 3%, where do you think the trillions of dollars sitting on the sidelines are going to go? They are going to flood into O for safety. It's not about getting rich quick. It's about wealth preservation. But if you want to crush the market, if you want to outperform the S&P 500, you buy Agree Realty. This is the beast mode version of triple net lease retail. Look under the hood. Look at their tenant base. Walmart, Tractor Supply, Home Depot. These aren't just stores. These are investment-grade fortresses. These companies are the backbone of the US economy. Even in a recession, people need to fix their homes and buy groceries. ADC is distinct because of its balance sheet. They are barely using any leverage compared to their peers. They are growing their dividend faster than realty income. And in a world of asset scarcity, this stock is a coiled spring. When rates drop, their cost of capital drops, and their spread on new properties widens. You are getting paid a 4 to 5% dividend yield to wait for a massive capital appreciation run. Now that we have hard assets covered, let's swing to the other side of the dumbbell. We need growth, but we refuse to pay 50 times earnings for it. We need deep value driven by human psychology. The market is emotional. It is manic depressive. It swings from extreme greed to extreme fear. That volatility is your edge. That is where you make the real money. Look at Zoetis ticker, ZTS. This is the undisputed king of animal health. They make the medicine, vaccines, and diagnostics for dogs, cats, and livestock. The stock has been smashed recently due to temporary noise about safety data and general Wall Street impatience. It is trading at a massive discount to its intrinsic value. But I want you to think about the consumer psychology here. This is why I love this stock. If the economy tanks in 2026, if we enter a Great Depression, what are you going to cut from your budget? You will cancel Netflix. You will stop buying Starbucks. You will eat ramen noodles. But ask yourself, are you going to let your dog suffer in pain? Are you going to stop buying your cat's kidney medication? No, you won't. You will spend your last dime to save your fur baby. That is what economists call inelastic demand. That is a moat wider than the Atlantic Ocean. Zoetis is a monopoly in an emotion-driven sector. Buying it at these levels is like buying a Ferrari for the price of a Honda Civic just because it has a flat tire. The flat tire will be fixed, but the engine is still a Ferrari. While we are betting on the permanence of pet ownership, we also need to bet on the inevitable future of technology. But stop chasing the chips. The easy money in Nvidia has been made. If you are buying now, you are betting on perfection. Instead, look at the physics of artificial intelligence. What does AI actually eat? It doesn't eat code, it eats electricity, massive, ungodly amounts of electricity. A single AI search query uses 10 times the power of a standard Google search. The US power grid is old. It's crumbling. It cannot handle the load. So, who fixes this? Enter NextEra Energy ticker. This is a unique beast. It is a hybrid. On one side, it is a boring, regulated utility company in Florida that prints cash. On the other side, it is the world's largest producer of wind and solar energy. High interest rates hurt them badly because building wind farms requires a lot of debt. But remember the macro thesis. Rates are coming down. This is a double benefit. Lower rates mean cheaper debt for NextEra, which boosts their profits instantly. Simultaneously, the demand for their product clean energy is skyrocketing because data centers need power 24/7. NextEra is the pick and shovel play for the AI revolution. You get the safety of a utility dividend and the upside growth of a tech stock. It is the perfect hedge. Do not, I repeat, do not just screen for the highest dividend yield and hit the buy button. That is how you go broke. That is how you become a bag holder for hedge funds dumping their trash. Let's talk about the elephant in the room. Let's talk about PepsiCo. Pep. Oh, but it's a dividend king. It's safe. Stop it. Look at the numbers. Look at the cash flow statement. For the last decade, their free cash flow has been basically flat, zero growth. But the dividend keeps going up. How? They are borrowing money to pay you. They are selling assets to pay you. Their payout ratio has spiked over 100% in recent quarters. That is a Ponzi scheme structure relying entirely on brand loyalty. But look around. The consumer is broken. They are tapped out. They aren't buying $7 bags of Doritos anymore. Volumes are down. Pepsi is engaging in financial engineering to hide the rot. It is a value trap. It might offer you a 3% yield, but it will cost you 30% in capital losses when the market realizes the emperor has no clothes. Stay away. And finally, before you execute any of this, we need to talk about the silent killer. The thing that nobody on YouTube talks about until it's too late. Taxes. The IRS. If you are watching this from outside the US, Hong Kong, Singapore, Europe, and you are buying US dividend stocks like Realty Income or HTGC in your standard account, you are bleeding out. The US government will take 30% of your dividend right off the top. Boom, gone. Withholding tax. You need to be smarter. Stop chasing yield and chase total return. Buy Berkshire Hathaway, BRK. Warren Buffett pays no dividend, which means you pay no withholding tax. You get all the compounding growth, and the US charges foreigners zero capital gains tax. It is the ultimate tax loophole, or by British American Tobacco, BTI, the UK does not tax dividends for foreigners. And for my Americans, my US taxpayers, do not put REITs or BDCs in a standard brokerage account. Are you crazy? These dividends are taxed as ordinary income, not the lower capital gains rate. You will get hammered with your highest marginal tax rate. Put them in your Roth IRA, put them in your 401k, wrap them in a tax shield. Do not work hard for your money just to hand 37% of it to the government because you were too lazy to open the right account. Listen to me closely. The easy mode of the last decade is dead. You cannot just buy an S&P 500 index fund and pray. We are entering a stock pickers market. 2026 is going to separate the sophisticated investors from the victims. You are standing at a fork in the road right now. Option A, you stay in cash. You watch your purchasing power melt away as inflation lingers and yields crash. You live in regret. Option B, you gamble. You chase the hype. You buy the top of the AI bubble and get rug pulled when the liquidity dries up. Option C, you build the nuclear bunker. You lock in the income with Hercules Capital. You pivot to real estate with Agree Realty. You buy the deep value moat of Zoetis. You bet on the infrastructure of the future with Next Era. And you optimize your taxes like a pro. I've given you the blueprint. Now you have to execute. Stay liquid. Stay skeptical. And don't be a hero, be a survivor. I'll see you in the next one.